Top-down analysis is the foundation of everything we are about to explore. In today's video, we break down the supply and demand trading strategy and connect it directly to the liquidity dynamics that move the market. Rather than looking at supply and demand as a basic support and resistance method, we approach it as a professional execution framework, driven by order flow, institutional activity, and price behavior. You will learn what supply and demand zones actually represent, why price reacts to these areas, and how to identify them correctly within the context of modern trading principles used across the stock market and Forex. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. So what is top-down analysis? Top-down analysis is the process of starting your chart study on higher time frames such as the weekly and daily, and then gradually moving down to lower time frames like the 4-hour, 1-hour, and 15-minute to refine your execution and build a more precise view of the market. Why top-down analysis is essential in trading? It matters because it allows you to understand overall market conditions before committing to any trade. When you begin with higher time frames, you can clearly identify the dominant trend and key levels within the broader market structure. As you transition to lower time frames, you are able to fine-tune your entries and avoid positions that conflict with the larger directional bias. In short, it helps you stay aligned with the market, filter out low-quality trades, and trade with greater clarity and confidence. To begin with, we can observe a clear downtrend on the 15-minute chart. Opening a short position during a pullback may appear to be a solid way to follow the prevailing trend. However, once we shift to the 4-hour time frame, it becomes evident that price has reached a significant market structure level. This increases the likelihood of a reaction at that area and forces us to reconsider whether the short trade remains a high probability idea. In a different scenario, the 1-hour chart shows a well-defined uptrend. When we move up to the daily time frame, we notice there is still considerable room before price approaches the next major structure level. With that context in mind, returning to the 1-hour chart allows us to plan a long setup with confidence and aim for the daily target. Looking at another case, price is consolidating on the 5-minute chart and seems confined within a clear range. A breakout in either direction could indicate the next move. Yet after zooming out to the 1-hour chart, we recognize that the higher time frame bias is bullish. This means our focus should remain on buying opportunities, since the broader trend is upward. If price breaks below the range, there is a strong possibility it will turn into a failed breakout. Should price move back inside the range, we can then search for long entries that align with the higher time frame direction. Consider also a situation where price pulls back into a supply zone, but uncertainty remains about whether it will reject and create a selling opportunity. In this case, dropping to a lower time frame can provide additional confirmation. A reliable reversal clue may come from a break below a trend line or a change of character through a break of the previous market structure level. From there, we can identify fresh supply zones on the lower time frame and execute with improved precision. Taken together, these examples highlight how combining multiple time frames results in clearer analysis and more accurate entries. Still, the advantages of top-down analysis or multi-time frame trading extend even further. This does not imply that we must begin from an extremely high time frame like the monthly chart and apply every concept simultaneously. Trading should remain straightforward because simplicity minimizes confusion, strengthens consistency, and enhances decision-making. With that in mind, let us continue with the top-down analysis technique. Under this approach, the process starts with the higher time frames, specifically the weekly and daily charts. The primary analytical work is carried out on the 4-hour and 1-hour charts. For added confirmation, traders may refine their view on the 15-minute and 5-minute charts. Through the integration of price action and smart money concepts, the objective of this top-down method is to determine the true market direction, mark key levels, locate high-quality zones, and execute a clean trade. Let's now apply this process step by step, directly on the chart. As the first step, we begin with the weekly time frame. On this chart, the only task is to identify and mark the key market structure levels. That is its sole purpose within this strategy. No additional concepts are applied here, as they are unnecessary at this stage. Since our main execution time frame is the 1-hour chart and lower, these marked levels help us anticipate strong reactions when price reaches them and ensure they remain clearly visible during lower time frame analysis. But what are market structure levels? Market structure levels are important price zones on a chart where the market has previously shown a strong reaction. Every reaction can be identified as a market structure level, but here are 5 key criteria that make a level strong. Number 1, acted as both support and resistance. When a market structure level has previously served as both support and resistance, it gains greater significance and increases the probability that price may reject it once again. Number 2, the move away was drastic. If price previously moved away from an area with strong momentum, it signals that the level carries weight and that price may react aggressively there again. Number 3, multiple rejections. When an area shows multiple rejections, it confirms that traders have responded to that same level several times, reinforcing its importance. The more rejections we see, the stronger the level appears. But this still does not guarantee it will hold. Only after a clear break and retest can we anticipate a rejection with more confidence. Number 4, turning points. Turning points are zones that have caused the market to shift direction in the past. Since the market has previously treated these areas as overvalued or oversold, there is a higher likelihood that price will respond to them again upon return. Number 5, recently respected. Recently respected or newly formed levels tend to produce stronger reactions because fresh levels generally carry more influence than older ones. Since you now understand what makes a market structure level strong and meaningful, we can return to the weekly time frame and begin marking those levels on the chart. Here we are looking at euro-dollar on the weekly chart. The goal is not to clutter the chart with unnecessary lines, so we only mark the market structure levels that are close to the current price. As you draw these levels, remember to position them where they capture the highest number of touches. It doesn't matter whether you draw from the candle bodies or the wicks. For instance, if the level is placed here, it only captures 2 touches, but when it is adjusted slightly, it includes all the major price reactions. In addition, think of these levels as zones rather than exact single lines. With that approach, we can see a key level at the top that has acted as strong resistance multiple times. So we mark it around the midpoint of that area. This zone has rejected price repeatedly and has functioned as both support and resistance, so we mark that level as well. There is no need to be perfectly precise at this stage, because we will fine-tune these areas once we drop to the lower time frames. Lastly, we mark the tip of the long lower wick as another important weekly level from the bottom. That is all we require from the weekly time frame. The purpose here is simply to mark the major market structure levels so that we do not trade blindly when analyzing lower time frames. With that done, we can now shift to the daily chart. From the daily perspective, the first step is to slightly adjust the weekly levels so they align properly with the daily candlesticks. After that, we mark the key daily market structure levels using a different color. This helps us clearly distinguish between weekly and daily zones when we zoom into lower time frames, since higher time frame levels carry more weight. Looking at the daily chart above the current price, this level has recently acted as both support and resistance, and the move away from it was strong, so we draw it near the base of that reaction. Another area stands out as a clear turning point on the lower time frames, which increases the probability of a reaction, so we mark that level too. At this point, we have everything we need from the daily chart. We are not adding any other concepts yet, because there are still more steps before we reach the 1-hour chart. Now, let us move forward to the 4-hour time frame. At this stage, the 4-hour chart is where we begin applying the core smart money concepts: market direction, imbalance, supply and demand zones, and liquidity levels. Before moving forward, let us briefly clarify these ideas so we know precisely what to identify on the chart and understand the purpose behind each one. First, market direction. When price creates a 1, 2, and 3 sequence followed by a breakout, a trend is established. If price continues by breaking above the most recent swing high, that signals trend continuation. As long as price remains above the latest protected swing low, the structure stays bullish, and we maintain a bullish bias on this pair. With each new breakout to the upside, the lowest point that caused the break becomes the new protected swing low. Once again, the bullish outlook remains valid as long as price holds above that level. On the other hand, if price breaks and closes below the protected low, a change of character occurs. This signals that buyers have failed to defend the structure and that sellers may be stepping in with control. It serves as an early indication that a potential market reversal could develop. Next, supply and demand zones. These are areas on the chart where traders previously entered the market and triggered strong price movements. Typically, we mark the origin of those impulsive moves as the supply or demand zone and anticipate a reaction if price returns to that area. That said, certain elements increase the strength of a supply or demand zone. Inefficiency, break of structure, and push distance. Inefficiency occurs when price leaves a zone with strong momentum, creating an imbalance between buying and selling pressure. This is often visible through fair value gaps formed between candles. These gaps suggest that there was insufficient opposing pressure at that level, which reinforces the strength of the demand or supply zone. Break of structure, as the term implies, happens when price moves beyond a previous structural high or low. This confirms directional strength and shows that buyers or sellers are still in control, validating the zone as a potential continuation area. Push distance measures how far price travels away from a zone after reacting to it. The greater the distance, the stronger the rejection tends to be, which increases the reliability of that zone. Here, we can see an example of a high-quality demand zone. The most recent impulsive move satisfies all the conditions of a strong zone. It created a fair value gap, broke the previous market structure, and pushed price upward with significant momentum compared to earlier movements. In this case, we can mark the first candle that initiated the move as the demand zone, or simply mark the last bearish candle before buyers stepped in. If price retraces back into this area, it presents a potential long opportunity. Next, liquidity. Liquidity represents the areas where stop losses and pending orders are clustered. It typically forms above swing highs and below swing lows. When liquidity builds above a demand zone, the probability of that zone holding increases because large market moves require liquidity to be triggered. The same principle applies to supply zones. A valid liquidity grab occurs when price moves below a level, triggers stop losses, and then quickly returns back above the range. When this sequence unfolds, we anticipate a move to the upside. With these core smart money concepts defined and understood, we can now return to the 4-hour example on the euro-dollar pair. On the 4-hour chart, a clear uptrend is visible. We can mark the breakouts and identify the swing points accordingly. However, price has now reached a higher timeframe key level, which has the potential to slow the trend or even cause a reversal. At the same time, just below the current price, there's a strong demand zone that aligns with an important weekly level. If price drops into this area, we expect a meaningful reaction that could drive it higher. In order to trade this 4-hour demand zone effectively, we would eventually need to zoom into the 15-minute chart to look for confirmation once price enters the area. For now, though, let us shift to the 1-hour chart, which serves as our primary execution time frame. On the 1-hour chart, the trend is not clearly defined. Price has formed a change of character by breaking below this level, suggesting that a potential reversal may be developing. Even so, we know that the 4-hour structure remains bullish and that a strong demand zone lies beneath the current price. At this point, the most prudent approach is to wait and observe which side gains control. If price breaks below the 4-hour demand zone, supply overtakes demand. In that scenario, both the 1-hour and 4-hour structures shift to bearish, allowing us to confidently search for short opportunities. Conversely, if price rejects the 4-hour demand zone and breaks above the daily structure, both time frames align to the upside, and we can begin looking for long setups. Let us now move the chart forward to see how price unfolds. After several attempts, price eventually breaks below the demand zone. This confirms that supply has taken control, and both the 4-hour and 1-hour structures are now bearish. As a result, we can focus on short setups. We mark the recent breakouts and identify the relevant supply zones. The equal highs above also serve as a liquidity level, further strengthening the setup. If price retraces into this supply zone, it offers a potential entry point. As the move continues, another breakout occurs and a new supply zone is formed. From here, we can continue taking short trades until price approaches the next significant level ahead. So, traders, top-down analysis is not about switching between time frames randomly. It is about building direction from the higher charts and refining entries on the lower ones. When structure, liquidity, and risk management align, you move from guessing to executing with clarity. Stay patient, wait for confirmation, and let the market come to your levels to build consistency over time. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Lucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.